Welcome to the Greenleaf podcast. Today we are covering some points and questions that we get asked a bunch. So one of the main questions we get a lot is, when are we going to get back into multifamily, or why will we get back in? So there's lots of reasons on our current position, and we want to just go through how we look at the market and share a little bit of the tips that we're using to assess like what is the right time to do it.
Right, and looking back on kind of our trend with multifamily, we really started aggressively buying in 2012, 2013. Had a nice run, bought about 4,000 units until about 2018, 2019. Things started slowing down on the buying side. We started selling more, and I think the last deal we bought was in 2020.
Yeah,
early January.
That's really when that multifamily, affordable, value-add platform, I mean, that was a very played-out investment strategy. And we kind of bought our last value-add stuff in that 20 time frame, which still takes 18 months to really go through that deal cycle.
Right.
So it takes you still into like late 2021, early 2022 of finishing those value-add projects. And those are really the last ones we wrapped up.
Right.
So from that standpoint, it's only been about 2 years.
Right. And also, you know, we kind of lumped together our mobile home parks because that's affordable housing and residential as well. We own our mobile home units, the actual homes, and we rent them to residents. And we bought 25 parks over about a 3-year time frame in really 2018, 2019, 2020 as well. And we still have a good amount of those. And so that's really where our data and our thesis is coming from.
Yeah. And all this is just based on our experience. We look at market information, but it can only get you so far. So a lot of times people are looking at, hey, should we invest in multifamily? They're looking at things like, what is the current cap rate trend? So, you know, what are things trading at? They're still trading pretty low. On the multifamily, even though debt is up, they're still trading pretty low. What are interest rates? You know, we touch base on that. They're definitely higher, so that has constricted some of the volume. And then other points that are very relevant are things like housing starts. What is the supply going in any market, and what is the population growth?
So like a good example of that is, we had a friend of ours that really built a really nice thesis around Buffalo, New York. This was in 2013, 2014. And he went to Buffalo, New York, bought about 600 value-add units for around 30,000 a unit. And his thesis was that Buffalo, New York had a very stable workforce, didn't really have a lot of ins coming in, didn't really have a lot of outs going out, but had enough housing demand and supply that he can make a business case out of. So he was there for about 5-6 years. You know, grew a nice portfolio, renovated, and then exited and did very, very well.
Yeah, but he had his exact thesis. Like, what was his play going into it? And the housing starts in the population one is one we've always looked at. We want to invest in areas that have population growth. We always thought, as long as there is consistent annual population growth for over a 10-year period, we should be in a good shape when we're buying multifamily assets. That was a big part of what we're looking at, but it's also why we're in the Southeast.
Exactly.
So that's why we are here in the Southeast. We're based out of Atlanta, so that's what it is. So there's those four like trends that you got to look at and identify where things are going to make this next point make sense, right? Mm-hmm. So a big thing we look at is it's our sensitivity chart. So put this up here and you see it's got a couple colors on it, but it's really showing our income on one axis and our expenses on the other. So if you look left to right on this, you can see our income. So you can see anywhere from a negative 20% to a positive 20%. And same thing on the expense side. Expenses could be negative 20% or positive 20%. And you'll see the impact that has. So we take our financial model, the numbers that we have for a deal, and we stress test this to say, what happens if our rents go up 5%? Or what if they go down 5%? So here we see we're starting around 11% cash-on-cash return. And this model that we have here for this deal, it was saying year 2, once we finish our renovations, we expect to generate around 11% cash-on-cash a year. Now, if we take a hit to revenue and we're behind, or say we're 5 or 10% behind revenue, or our expenses are 5 or 10% over, what does that do to the deal performance? Kind of goes into the green means we're exceeding our preferred returns. The white area is essentially we're above 0, but we're not hitting our preferred returns. In our case, it's always been around 8% a year is what we're targeting. And then if it goes red, it means it's less than zero, negative returns. That's obviously not what you want to see on a cash flow standpoint. But you can look at this and say, hey, how much buffer do we have before things go negative? And it could be, hey, we have to see a 20% reduction in revenue, or we've got to see a 25% increase in expenses, 30% increase in expenses before we see negative cash flow.
And this kind of goes along with our thesis as well of locking in as many variables as we can, specifically when it comes around debt, is locking in long-term fixed rate debt. Because as you can see that if, we only have, this whole deal has about $200,000 of free cash flow. If we double our interest rate, it wipes out all, right, $200,000 of additional interest that basically goes away. So we think it's too risky to basically long floating rate debt. So we prefer to long fixed rate debt.
Yeah. So to cover within our chart, what we can see here is, and this is showing income in controllable operating expenses. If we add interest expense into this deal, and in this deal, for example, our interest cost per year is about $200,000. If we double that to $400,000, we've got to make up $200,000 in revenue. We'd have to add 20+% revenue to just stay at where we're at. Out of the gates, like that. That's what we have to do. So that's a big ask.
Yeah, and it's a big explanation of what's happening in the market right now, where people are struggling with their multifamily deals that are on floating rate debt and how they've scrambled to lock them in.
Right. Yeah, they've got to drastically increase revenues just to cover the interest part of it that has gone up. Now, it's some things when we look at these deals, we're always saying, okay, this is what we forecasted, and how are things going, and that really dictates. We look at a sensitivity. When do we think we're going to get back in and buy something? So a couple of these areas on the expense side, we're winning. We feel like we're winning, or we feel like we're performing well at. If you've ever been to our office, we have the same flooring and everything in our office that we put in all of our apartment homes, right? I mean, we use the product that we put in them. So we use LVT. We use this grayish wood grain LVT floor that we've used for a while. It's easy to clean. Doesn't scratch.
Easy to replace. You replace it section by section. Simple.
So that section of flooring, carpets in the bedroom. But our flooring costs, we've seen about a 3% year-over-year increase in flooring costs since 2019. So it's been fairly steady. It's been lower than our increases on revenue. So that's been a positive, right? So that's one thing we're like, okay, we feel good about that. Our flooring vendors, you got to have a good flooring vendor wherever you're owning multifamily, and making sure they can get in there and clean things up. I mean, they make an apartment look tremendously better when you have a good flooring crew. A lot of people do it in-house. They're buying the material and storing it and then going and putting it in. Really just depends on what your staffing looks like. If you can do that, sometimes it's a lot easier to just have a vendor that's really good and have them do it.
Yep.
They're installing flooring every day. They're good at it. Yeah,
they usually need maybe 48 hours notice. They're in there, just rip it up, put in the new stuff.
Yeah, our flooring vendor is like a couple hundred yards behind us in another office building right behind us. So they're doing a great job. Elite Flooring. They're excellent here in Atlanta. But that's where we feel like we're doing a good job. I mean, another part we're doing really well, landscaping has been pretty controlled, which is odd because it's a very labor-intensive business, but we haven't seen crazy cost increases there. So it's like, okay, this part of the thing is going well. Another part that's going well is really like our team's productivity. We look at metrics from a standpoint of people per unit, and that's really our team members. How many team members does it take to effectively operate a number of units? And what's our revenue per person? Those are kind of how we're assessing the efficiency of our team. And we've seen that go up significantly over the past 4 years. We've almost doubled in that utility rate there, which is great. But sometimes it's just making up for other parts of the business that aren't performing as well.
Yeah. So, are that revenue per person or the number of units per person? I think we attribute that to our tenure. I think our average tenure now is over 4 years.
Yeah, it's almost 5 years. And as people know your systems better, know how to operate, and know what your cultural expectations are in an organization, they can definitely operate easier.
Yeah, I mean, we have multiple people on our multifamily team there that are graduating their 10th year with us. So it's incredible. They've been along for the ride with us, and it's been a fun ride, and as well as they've really helped build something pretty incredible with us.
Yeah, Leslie's coming up on 10 years too. That's like right at the end of this, and it's it's like you've been on so many different properties. We buy something. We're always buying problems and trying to solve them, and the more times you can go through that process of buying a problem and solving it, and going on to the next one, doing it again, the more comfort you get with like, oh, I've done this before. The first time you do it, though, is just like, holy crap, what is going on? Why is this such a disaster?
Right.
But, that's the fun part. That's what we're looking for. So, yeah, a great team definitely helps with that ability to do some of these projects at a bigger scale, right? So in our business, what we're seeing is those things have all performed well. Our revenue, when we look at this chart here, our revenue growth, we touched on this at the end of the second quarter, is trending about 8% for 2024. So we can see we've got revenue going to the right about 8%, and then we have our expenses going up about 3% on those categories. Now we got some other categories so that we feel like we're losing on, and until we can get more that we're winning on than losing, that's really when we say, okay, we see the shift in multifamily, we'll get back into investing in stuff, as long as we also have a good cap rate trend that we're buying at.
Good long-term fixed debt.
Good long-term fixed debt and population growth.
Exactly.
We think we fixed population growth because we're in the Southeast.
Right.
So that's why we'd really only look in the Southeast where we see population growth. But I mean, there's markets in the Southeast that don't have population growth though. But we were just looking at some reports. I mean, Atlanta's 1.3% population growth this past year. So it's exciting. It's like a top 10 city in the country for population growth. That makes it a lot easier to make investment decisions if there's more people moving there.
Yeah, with the rest of our markets like Chattanooga, Charlotte, right in the same in the same
and Charlotte
range.
was higher. Charlotte was like top 3 in the country.
Right.
On I think theirs was like 2.1% for the past year of population growth, which is fantastic.
Right.
So areas that we're facing some challenges in, and when we see that's really overall, we're seeing about a net zero on our margin on the residential side. In our experience, this isn't what other reports are out there in the market, but what we're seeing is our net margin is about flat on the residential side. And because we have a couple categories that the costs are going up. In Georgia specifically, our utility bills here, we've had pretty competitive utility rates, but up 29%. We have, I think it's the only new nuclear reactor in the country.
Yep.
We have one. It's a country. Whether you're pro-nuclear or not, I don't know.
Right.
But we've got one. China's got like 100.
Yep.
But we've got one, and because of that, which is odd, our utility rates went up. And that project took a long time. It was over a dozen years and well over on budget. So we've got some
catching up to do.
Cost recapture that was put into our utility bill. So Georgia utility bills are up about 29% year over year. So that's significant. Especially a residential asset, you have in the South is normally called unregulated lighting, which is all the street lights and everything you're paying for. And then you have all the common area, hallway lights and that kind of stuff that you're paying for as well. So that stuff's up 29%, which is that's a big jump year over year. Some other areas we're seeing increases in that not only impact us, these impact our residents as well. A utility bill, we're paying it. Residents are also paying a utility bill. And for the most part, people only have so much money. So it gets divided up.
If your utility bill's, say, $150, which is probably reasonable for the size units that we're renting, it goes up by 30%, an extra $50. That's real money relative to the size of the spend in that unit.
Yeah.
When rent's only barely $1,000 a month.
Yeah, so that's going to mean that for us to maintain our retention, we cannot raise rates. Like that $50, there's not room to send that to rent. That went to utilities. So your rental rates cannot go up by that $50. Right. That's how we look at it in our world. And in that, we've been able to maintain over 70% retention. So we can't do that if we raise rents too much.
Exactly.
Another one that we're seeing are appliance costs. Appliances, they've gone up about 10% a year for really 4 years. We were looking back through some of our numbers, and 2020 we could buy a entry level. We use 18 cubic foot GE refrigerators, like into the kind of the weeds of what, how the operating is happening. But that's what we're typically buying. We're not buying like 100 at a time and storing them somewhere. We are going to an appliance retailer. We have commercial accounts. We get a little bit of a discount, but we were paying around $565. Now we're paying $750.
I remember when they were $399. I remember we used to do a whole kitchen for $1,000.
Oh, $1,000 on appliances.
Yeah, $1,000 for the stove, the range. The stove, the hood, the dishwasher, and the refrigerator.
You remember when you bought all the used appliance packages because they were out of a
awesome.
demo one, and then we had to replace them all?
Yeah, they had to replace them all.
Yeah. Some deals are
the deal was great on the front end.
good on paper.
Yeah.
Maybe not the greatest.
Yep.
In the working environment, but no, we occasionally you can come across these options where someone's doing a renovation, or at least you could, right? And they're like, "Hey, we're gonna get rid of all these appliances," and you could pick some up for really cheap.
I negotiated the shit out of it. Like I worked those hard.
I know, but yeah, they just didn't quite, transporting appliances and getting them to work. It was a valiant effort. The play didn't work as well. Maybe we just got an equal value. I'm not really sure, but
there we go.
But no, now most of the time we're looking at 18 cubic foot fridges, and the run us around $750. And then obviously that's us. We're doing that as cheap as we can from a standpoint of we'll go get that thing, and our guys will put it in.
Yeah.
So we're not paying for like delivery fees and installation fees and all that stuff. So we're really just looking at the pure material cost, which is up, 8%. The other one that's literally like a giant pain in the butt is the HVACs. Right, we look at our cost per ton to install a unit, which has essentially doubled in the past like 2.5 years. That's doubled. Another kind of battle we go through is
more insult to injury.
Yeah, you put in a new system, and if you know it, again in the details of these HVAC systems, it was R22 refrigerant.
I feel like the R22 was around forever. HVAC was invented, and they used R22 until we got into the business.
Until the 410A came, and like, okay, we're going to phase out all this R22 refrigerant. 410A is safer; it's better for the environment. Oh, that's great, but now you have all these old 422 systems that you either had to try and convert to 410, different size line sets, and you'd be swapping out parts that just wouldn't work that smoothly. So you had to swap out all these HVACs, and you go to a 410 system. And that then made anything that was left over, the R22 refrigerant, skyrocketed in price, up hundreds of percentages. So that made it unaffordable. So now you have to switch the system. And now, again, we're phasing out 410A. We're going to 454A because it's going to be even better. But that means we're going to be doing more system swaps, more cost of refrigerant that, we want to do what's right. We want to do we obviously don't want to be contaminating anything. But at the same point, this cost structure makes operating and repairing the HVACs very costly. So that's gone up tremendously.
I wonder how many units we had that just kind of skipped the 410 migration.
And held an R22 charge for like an 8-year period.
Andrew has one at his house, right? He has like a 30-year-old system on his house that he was talking about the other day.
That's still maintaining an R22 charge? Whew. Things are bulletproof system.
Yeah, exactly. Things were built well.
Yeah. Yeah, so a lot of the new systems, I don't know how he's doing that, but a lot of the new systems, it's like, man, we got to go replace those now too. So our cost structure on those is it's hard.
Yeah. So, so at the end of the day, we are seeing good rental growth, 8+% rental growth, but our controllable expense growth is up about 20%, which at the end of the day, that makes net income flat.
Yeah.
So we're not seeing any net income growth. So in order for us to get excited about multifamily and want to dive back in and start buying units across the Southeast again, we really want to start seeing NOI expansion so that basically rental growth outpaces expense growth. Not that it's equal.
Right. So the only other one, so there's not much, we can't really do much about the refrigerant costs, right? We can't do much with Georgia Power. We can call them and ask them nicely. We can't do much about appliance costs. So we can work and look for better deals and negotiate stuff the best we can. The other one we're seeing, probably it's a lower cost. It's definitely a significantly lower cost. But the percentage growth in cost is the highest of anything we have, and that's software, which arguably has the highest margin of anything. I don't know if software's helping us or if it's just making things worse.
We were joking about DocuSign earlier. It's like it might have just been easier to go back to the print it, bring it over our desk, sign it, and then go back and scan it,
rescan it, and send it back in. Our cost of software, and these are businesses operating at 50, 60, 70% gross margin. Our DocuSign for a couple people was $13,000 for the year. It's like there's a cheaper option.
There's not really DocuSign's not really bringing in feature enhancements that's really making our lives better.
Nope.
It's like they delivered a great product, and now it's just all margin.
When it was hundreds of dollars, like 10 years ago, I was like, this is great. It saves our document. We can sign electronically. We were sending it to tenants all the time to sign it. We don't even use it for anything like that anymore. It's just internal signatures. So that's one we're going to save some money on. So we're excited about that. However, it's like those costs of software they're painful to look at. Mm-hmm. Our Gmail costs, there's a suite that kind of goes in with Gmail that I guess has just been bundled into the stuff. But we use Gmail as kind of our back end for our email, and that's, gosh, what is that? We're paying like $40 a person a month now for Gmail. It was, when we first did it, it was like $150 for the company for 100 people.
For the year or for the month?
Yeah, no, it's like per month.
Okay, per month, okay.
So it's pretty cheap. Now it's 20, Google gave away their Gmail service and someone else bills us basically. That's $2,400 a month. So some of these are like embedded technology. It's always hard to cancel and move to the lower cost option, but I would imagine it's a great place to look for cost savings because we're doing about 2 to 3 software transitions a year right now. If you're an investor with us, we just went through one big one. We moved to a platform called Agora, which it was a lot of work, but provides all the same, if not more, functionality. It provided us a little bit better back-end transaction of how to move money for investor disbursements, which all of our investors are a fan of disbursements every quarter. We send those out on the 20th. So we've got to be able to do that seamlessly without any mistakes. It's got to work every quarter.
Right, and added on to that is Agora promised to integrate the tax returns in the process. So we should be able to deliver our tax returns and K-1s faster and more efficiently by using their platform.
Yes, they're helping on some of the reporting stuff as well. And it's been a good transition with them. But we're always looking for like what software can we work to. Right now, our initiative is really how do we reduce our software number of applications by 30% by the end of the year. We really want to like dig through some of these and see like which ones can we find a better way to do. Just because those costs on a percentage basis are taken off. That's kind of like when is AI going to actually provide some benefit?
Yep.
I don't know. We have not seen that yet. But so those couple categories is when we say like how are we going to get back into multifamily, it's like it's close. We have a couple categories we're doing really well in. We have revenue that's holding right now. Retention looks good. We've got a couple cost categories that maybe it's like settling down really from the peak of inflation in 2022 is where we saw the biggest bumps. And now looks like it's trending down. So as soon as that kind of like comes under control, it's like then our sensitivity charts, along with we have the right population growth and the right market, are going to say that it's a good time to invest in multifamily. So that's what we're looking at on that front. It's getting there. I feel like we said it's been getting there for a while, but this is, when we say it's getting there, this is exactly what we mean on the specifics of when it's going to get there.
Right.
So it's trending in the right direction, and as soon as we see that kind of term where we can see margin expansion, we'll look at jumping back into more multifamily deals. Another thing on the real estate front, let's jump subjects.
Okay, yeah.
Do another one. We'll have this chart up. It's pretty cool to look at. But we travel a good amount. We love traveling this weekend. Well, we did a running race this weekend, but we didn't travel.
Right.
It was here. At Peachtree Corners, it's like
The
right by
glow
our
race.
office. There's a nighttime glow race, so we did the 4-mile run on that one. Our kids did the 1K run. I think it was 1K.
Yeah, it was 1K.
1 mile, 1K.
Yeah. Owen was a monster.
How far is one?
It's like half a mile-ish.
It's like up the hill and back the hill.
Yeah.
But no, like doing these little adventure runs are super fun. So we did that one on Saturday. We didn't have to travel though, but when we are traveling, we're typically not hotel guys. We're looking at how can we do like a Airbnb or a VRBO type option.
Yeah, neither one of our families really fits into a hotel room. So you either have to like negotiate with the hotel desk, like, can we please get 2 side by side?
You have to sleep in the lobby.
Yeah, or in the
Or
car,
go to the bathroom to try and get anything done.
Exactly, and then the wrestling match of like breakfast and like how to feed your kids in a hotel room is just a disaster. So the Airbnb VRBO option is always a better option for kind of big families with young kids.
Yeah. So Josh got 4 kids. I got 3 kids traveling. But we were looking at, we're always following kind of like what's happening, and we saw Airbnb went down 13%, and kind of the news was negative. We're looking at it, and we're always interested in how you run a business and what you're doing to operate it, and
and how to drive growth.
Yeah, and
especially tremendous growth.
Yeah, and there's always bumps in the road and things happen, but if you just Google, and Google now has their AI response that comes up right away, but if you just Google Airbnb bookings year over year, over the past 4 years, they went from 193 million, which is a staggering number to begin with, to 448 million leading into 2024. It's like incredible growth.
Yeah. And
that's a staggering amount of usage going to Airbnb.
Yeah, the stock was down on growth going from 18% down to 11%, but on the number that was now 400 million instead of 192 million.
448 million.
Yeah.
That's a heck,
yeah.
That is those guys, they started that business like 17, 18 years ago, I think, or something like that, but that's pretty darn impressive.
Yeah, and it's such a great platform. It allows you so much flexibility. I love VRBO, but VRBO is normally by the week. Airbnb is, by the night in really any city in the world. It's just an amazing platform.
Yeah, but it's a pretty cool story. I mean, just, there's a news media of why the stock went down, and maybe it recovers some, and maybe it doesn't, right? But just looking at their story of what they've done over the past couple of years is pretty darn impressive, from scaling a business just even to get to 193 million, anything, right? Pick anything 193 million of, and now they're at 448 million a year is it's pretty darn impressive. So it's an interesting article to see, regardless of the stock impacted.
Right.
Yeah, I know everyone out there, you want to make money on investments and stuff, but that's a business that seems like it's scaling and growing, which is very cool.
Yep.
So, all right, what do we have for this week?
Yep.
We're missing Andrew. He's out trying to get more LOIs out on our Dollar Generals. We're aggressively looking at how do we expand that footprint and look at these things. We're taking the approach not to all states, but more states that have positive population growth.
Right. I mean, this cap rate trade is really what we've seen over the last 15 years, is that, especially in the retail business, is that it really cap rates in retail really trade on a spread to interest rates. And with interest rates kind of being at a last 10-year high, and we see them coming down in the near term, we think we can pick up some Dollar Generals at some really high cap rates that will just the cap rates will drop down as soon as interest rates drop down.
Yeah, I mean, the general consensus that interest rates, they're going to see some rate cuts.
Right.
It's always interesting looking at the betting market. People are like, what do you think is going to happen? I was like, let me call them and I'll ask them real quick what they plan on doing. But the general consensus looks like they're going to come down. And anytime buying real estate in a high cost, high debt area, it's like that's typically when you're going to get a better deal. It's way more challenging to get the deal done at that point in time. Leverage is less. We're looking at our Dollar Generals. We're not looking at putting debt on anything right now. It's just not an attractive environment for that type of investment. So buying with cash is a little easier to get the deal done, a little quicker to make things happen. I feel like we'll be able to pick up some good deals as we keep looking through this strategy on the Dollar Generals, and we'll see what we can get done. But Andrew's out today working, trying to get him out the door. So we got to send out a lot of offers. We got to talk to a lot of people to find a good deal that we can transact on. So it's definitely a hustle to get things done. So hopefully next week, 2 weeks from now, I'll have some more updates on deals that could be live. We'll share those too. So cool.
That was good.
All right. Thanks for watching. Let us know if you have any questions. See you, folks.